Okay, everybody. A couple of comments of note. A reminder that, hey, when you guys get one of the YouTube videos of the lecture, remember that you can either slow it down or speed it up using one of your widget tools that are sitting inside the YouTube interface. And I also, of note, I renumbered my lectures, and I'm trying to line them up in a more coherent fashion. And so before there was a little bit of a tricky back and forth with numbers in the lectures summary list. So I fixed that, and also of note, I want to point out to you guys that what you should be looking for in terms of your homework. So you remember you have Connect homework. And that's just a series of sort of quizzes. It's like reading checks, trying to keep you on time. Don't be egregious in terms of just answering randomly. I'm just double checking to see if you're understanding stuff too, but it's for completion's sake, right? The quizzes that you'll take are inside Connect also, and those primarily are driven by the Connect material, which remember, the Connect stuff is connected to the Higgins 11th edition book, which is a little bit more on the analysis side of things. And right, of note, it's got lots of great ideas and tools in it, but it's not a complete text. There's lots of gaps, right? So you have to watch out. And that's why I have the other PDF documents in place, all right? So homeworks and quizzes. The quizzes are for grading, right? Your final exam in particular, right? That is driven by the lectures that I'm doing, okay? So everything interacts. There's a few hiccups here and there where Higgins doesn't line up very well with the books that you've got. My lectures, they line up with Burke and DiMarzo. So you're probably wanting to think of that as your primary book that that you can draw your lessons out in parallels to, from the lectures to the texts. And then the other book, the Ross book, is just really, really helpful because it's very complete. It's very huge, also very high page count, right? So what we're going to do now here, completing material for week 3, we're going to do lecture module. I'm going to call it lecture module 6, okay? And I'm going to try to do this in maybe 2 parts. We'll see. So let's call this part A. I'm hoping to just do this in 2 parts. And what I'm going to do here, we're going to introduce capital budgeting. Right? And capital expenditures, right? This is outlays for fixed assets. Often these are large, right? This will commit a firm for a very long time period, right? And you don't want to be making mistakes here because of the size and the length of time of these types of investments. You have very large impacts on shareholder wealth, right? And especially, of course, remember for capital-intensive firms, this is very, very critical. Capital expenditures are much different from operating expenditures, right? Operating expenditures involve the outlays that you make for labor and materials, and, right? These generate your current period revenues, and they're not considered long-term. Now, what we're going to do again, we're going to assume that the relevant opportunity cost is R. Okay, R, the required return that you have to get is the market rate of return. And we're going to learn a little more about how you establish the value of R later. So you're going to generate returns on projects. Now, the value of R in a particular project that we establish, it's going to be risk adjusted, okay? And again, we're going to assume that we have an immediate problem in front of us, and that's to forecast the future cash flows. So we're getting into forecasting of cash flows, and you've already done a little bit of a forecast kind of task by studying the Higgins text in terms of the pro formas. Now we're going to take some of those lessons, and I'm going to throw the difficulties at you to show you that this is more complex than it seems. In the textbook environment, things look a little bit canned. So a couple of things, right? When you're forecasting cash flows, right? When you go further away from time period t equals 0, right? T equals 0 out to time period n, as you go further towards N in terms of a far future, right, cash flows become more difficult to predict. And right, so see, forecasting a little easier in the short run, a little more tricky to pull off across the longer period of time. So we have lots of forecasting methods. We'll try to look at some of the guiding principles here. That's the real sort of management issue that's at hand for us. Now, remember that when we have cash flows happening in the future, that we're going to have to put them through the discounting process. And because the discounting process relies on R, and it's a risk-adjusted value of R, we're going to kind of capture the idea of the uncertainties in the discounting step. Okay, future cash flows are going to be penalized in terms of their present values the farther away they are, so that we kind of put less and less and less weight on those. See, so as you move further away from the present time period equals 0, right? There's a we'll call it greater discounting, right? So that's partially good news. That's saying, okay, yeah, it's harder to predict that thing 20 years from now, but we don't want to give it a lot of weight in our decision, right? So it's going to have a very, very small amount of weight. So that's good news. And of course, with regard to cash flows, with our outlays especially, right? When you look at outlays in time period 0, right? You know these with a lot of more precision, right? You have much more precision. So decisions made regarding the present are, of course, far more accurate. Still, a little bit of uncertainty will be in the midst of that, right? Of course. I'm just going to list out, call these the golden rules. Let's list out the golden rules, okay, of capital budgeting. This is meant to set us up for some applications that will happen later, okay? So these are golden rules. And there are 8 of these items, and we'll go process through these. Let's just list them out first, okay? So golden rule number 1 is that we want to identify the project cash flows, right? Don't let yourself get distracted. Second rule, right? You must remember the net working capital requirements that are both going to be, there's going to be cash inflows, there's going to be cash outflows. So I'm going to call that, right, NWC, standing for net working capital, and we'll come back to that to explain it a little more. You have to remember that, right? And keep in mind that these are going to be going both directions. They can be inflow and outflow. Thirdly, you must pay attention to the incremental cash flows. Incremental cash flows, okay? This is a lesson from economics. You think at the margin, okay? So a way of thinking about this, remember, is that sunk costs are not recoverable. That's why they call them sunk. So sunk costs are not, right, or they're not relevant. If you pay attention to them, you will get yourself into one of the decision-making traps. The most important trap of note is escalating commitment. You might recall that from an organizational behavior course or maybe a leadership class. Fourthly, right, do not forget opportunity costs. Opportunity costs. These are faced by the investors. You gotta definitely remember that. Okay. Point 5 is you must never neglect taxes. Right. Do not neglect the taxes. You have to account for taxes when you're considering capital budgeting. Okay. 6th, you do not include financing costs. Right. Right. Because those are born regardless of project. So those would be kind of messing with your comparisons, right? So do not include the financing costs. Number 7, I'll put over to the right a little bit, okay? Treat inflation consistently, right? You got to keep in mind inflation, and don't be inconsistent. Be consistent. And the 8th rule is recognize what we'll call project interactions. And that one's a little tricky because a lot of firms have more than one project, right? So we've got to include some kind of some kind of frame, we'll call it, that accounts for those possible interactions. So rule number 1, remember, is cash flows. Crucial. You must identify the cash flows. You actually might be kind of tired of this. It's a mantra, okay? Cash flows, cash flows, cash flows. Cash flows are king. Cash is king. Cash is the lifeblood of the firm. Please remember, not accounting profits. That doesn't generate the firm's vitality. You have to have cash to pay dividends, to pay the bills, to keep the firm solvent. What accounting procedures are doing, they're helping us to identify the size and the timing of the cash flows. So how do you depreciate an asset, right? That's going to affect the size and the timing of tax payments. And tax payments are a cash flow, right? An outflow. So you have to be very well versed in accounting procedures to understand how one would measure and properly identify cash flows. Now, it's possible, of note, to net the cash flows when you're working. Net as a verb here. You can net the cash flows if you're working in the same time period, right, of flows. So using a netting, if you have inflows of 500 in time period T5, right, and let's say you have an outflow of 200. Same time period, right? So you can have a net, right? A net flow, right? Since your inflows are greater in this case from the outflows, you see you have a net inflow in that time period. So that's fine to do, okay? And you're going to assume that, like, let's say that the cash flows occur in very discrete time intervals, right? So you have to keep in mind the time intervals. So it helps us be careful and precise about estimating the cash flows. Now, it doesn't mean that we're justifying, say, precise mathematical techniques. But for our purposes with budgeting analysis, we're going to assume annual cash flows. All right, so that's just something that we're going to do for these capital budgeting problems. Okay, and we'll treat an outlay or an inflow when it occurs. Okay, treat it when it occurs. The cash flow is identified. Why would I say this? Right? What's going on here? Huh? It looks like what? I mean, why is Dr. Walker paying attention to that particular issue? A little bit of question mark on that, right? Well, here's what's going on. You do not identify the cash inflow or the outflow when the accounting rules recognize the expense or the revenue, okay? See, accounting methods for capital expenditures, you're going to capitalize them on the balance sheet, writing off some of it by depreciation over the life of the asset. See, look at an example. Let's say you have a fixed asset in time period T0. It costs, let's say, you have a cost of a fixed asset. Let's say it's 500 and you're in time period 0. Okay, let's expense that at $100 per year for 5 years through the depreciation method, right? Just a straight line, even depreciation. Just over 5 years. So you treat in finance, the $500 is an outlay at time period 0, right? So from the perspective of our analysis, we're saying at time period 0, you have a $500 outlay. Okay, that's a real cash flow, right? Now, over time, the depreciation expense is happening, but it is not a cash flow. It's just a write-off that helps us affect our actual tax expense, right? So, well, look, okay, so let's say we're looking at depreciation, an accounting tool, right? And it's not a cash flow. Let's make sure we know that. Not a cash flow. That's a mantra too. It's an expensing device. It affects the tax flows, right? How? Because it alters the tax payments that happen, right? So it's sort of an intermediate thing, right? It alters the tax payments. Tax payments are a cash outflow, right? And of course, there are other non-cash sort of charges like amortization and losses on assets, and they have very similar characteristics to depreciation. Suppose you have two firms, okay, and they have the same earnings, okay. Let's do firm A and B. Make a little chart right here. And let's do earnings before depreciation and taxes, okay, of 100 in each firm. And let's say that we install a depreciation in firm A, make it 20, and in firm B, no depreciation. So now you have earnings before the taxes, 80 in firm A, 100 in firm B. Let's put, let's say taxes are 40%. Okay, so you have a $32 tax in firm A, a $40 tax in B. So let's look at earnings, right? And now it's after tax. So in firm A, you have $48 in earnings. You have 60 in firm B. Now add back the depreciation. If you add back the depreciation, of course you got 20 in firm A and none in firm B. So now we see some cash flow. Right, 68 in firm A, only 60, right? Because of the higher tax payment, right? So even though firm A shows lower profits after tax than firm B, firm A's cash flow is higher. See, a higher amount of cash flow, an $8 extra cash flow. What's going on, right? Firm A has $8 less in tax expense than firm B. So firm A has $8 more in cash flow. Adding back the depreciation to the earnings is crucial, right? Because it is not really a cash outflow. It's just an expensing device. In general, right, depreciation expense results in tax savings, right? Now, the amount of the depreciation expense, right, so this is our general rule, right? The amount of the depreciation expense times the tax rate, right? That's equal to tax savings. Driven by, right, public policy. In our case, we had what? I had $20, right? And we had a 40% tax. There was my tax savings of $8. The depreciation expense, and really any non-cash charge like amortization, though it's not a cash flow, right, it actually reduces real cash outflow, in this case taxes. And if you can avoid an outflow of cash, that's valuable to the firm. That's just as valuable to the firm as having a cash inflow, right? So avoidance of outflow. See, that's what's going on. So pay attention to the outflows. Very, very crucial, right? Let's see. Let's do rule 2. Okay, rule 2 is do not forget the net working capital requirements, right? This is a part of our capital budgeting analysis always. And these are, of course, happening as outflows, right? And they can be happening as inflows when we consider the capital budget. what we're doing here, we're taking into consideration differences between what we call the accounting recognition of the revenues and expenses on the income statement and when that cash actually does occur, when the cash flows occur, right? So you might have credit sales, and those generate accounts receivable. So what's going on? Accountants recognize the credit sale as revenue, right? But the cash flow does not occur until the customer pays for the item. So if the only current asset or the current liability that changes is an increase in the accounts receivable, we would subtract that increase from net income to adjust the net income back to the cash flow basis. Suppose there's credit purchasing happening, like that generates an accounts payable. See, so what we're talking about here, accounts receivable and accounts payable. In the accounts payable mode, you might purchase an item, so that's part of costs of goods that are sold in your period. It comes from the income statement as an expense, and it has not been paid during that current accounting period. See, so the only current asset or current liability that changes is an increase in the accounts payable. You have to add that back in to the net income to adjust net income back to the cash flow basis. See, so again, accounting decisions are being made, and we have to make sure we make an adjustment to get ourselves back to the proper cash flow numbers, right? So what you do is you collect the changes in the current asset accounts in the period, okay? So collect the deltas in the current asset accounts in the time period. Okay, and you subtract changes in current liabilities during the period to get your change in net working capital. Okay, so you subtract these deltas in call it current liabilities, right? And that gives you a change in the net working capital, right? If the net working capital increases, then you have a cash outflow. Okay. If the net working capital decreases, you have a cash inflow in that period. So you have a couple of steps to follow, and then you can figure out whether you have this cash inflow or outflow. So again, what you're doing is you're seeing that there's an accounting recognition of revenues and expenses, and the actual cash flow, where we would identify the occurrence of the cash flow, is it just an adjustment process. So you're adjusting accounting profits so you can identify the change in the net working capital. Okay. So let's say that before you take a project on, and put that project into the books, let's say a firm has the following current accounts in its balance sheet. Okay, so let's see, here's current assets, current liabilities. Okay, let's say that there's cash, accounts receivable, and inventory. Okay, and you can then, of course, sum the current assets. Let's say you've had 100 in cash, 150 in accounts receivable, and let's say 200 in inventory. So these all add up to 450 in current assets. Accounts on the current liability side, let's say you have accounts payable of 50 and taxes payable. They're coming due at 50. And you have wages payable. These are the typical current liabilities, right? Let's say 40. Right, so you have current liabilities of 140, right? So notice now the net working capital. So you take the current assets minus the current liabilities. So that's what, 450 minus 140, right? So that gets us 310. Let's see. The net working capital at 310, right? So there you go. Now let's assume the capital budgeting project that you're about to undertake, let's say it requires increases in current assets, and perhaps it generates some additional current liabilities. Okay. So for instance, the project might require, increased levels of cash and accounts receivable and inventory. The same project results in some additional purchases, so you're seeing an increase in accounts payable as well. And you're going to owe more in taxes, you're going to have higher wages payable. So say the project's about to be taken on, so let's say that the project generates a new balance sheet. So we're going to examine the sort of a pro forma part of our work, and the current assets and current liabilities wind up looking a little different once the project is imagined as being in place. So let's say you got 150 in cash, okay, and 300 in accounts receivable, 400 in inventory, okay. So now your current assets are going to total, what's 850, right? And let's say your accounts payable and your taxes payable and your wages payable wind up being, let's say, 150, 100, and 100. Right, so your current liabilities are summing now to 350. So now your net working capital, current assets minus current liabilities, that's right, 850 minus 350, right? So that's 500. So net working capital has increased because of the potential adoption of the capital budgeting project, right? The increase is 500 compared to 310, right? This number compared to 310, right? So you're committing funds to the project, right? This is helping us understand, well, yeah, we're committing fixed assets to the project, but of course funds are being committed to it also. So you must include the changes in the net working capital requirements, as well as this is affecting, of course, fixed asset elements on the balance sheet. But now we're seeing these cash flows related to the project itself, right? So when you include the net working capital change here, you're adjusting the income statement, and that's reflecting the actual cash flows that are experienced by this firm, right? The amount of the net working capital required to support the project is changing as the revenues are being generated by the project, right? And from year to year, you might see the project revenues going up, going down. The net working capital has to be included as part of the project's other cash flows. Now, at the end of the life of the project, right, the project no longer requires net working capital support. Okay, so you might return, right, to the remaining net working capital as an inflow for the project. So you can illustrate this. Use the timeline, right? Such a useful tool. Okay, let's do rule 3. We're getting there, right? Rule number 3. So rule 3 is this: only include incremental cash flows. Incremental cash flows only. You have to beware of phantom cash flows, and you have to be aware of sunk cash flows, right? So no, call it phantom cash flows, and no sunk costs should be part of our analysis, okay? See, the goal in the capital budgeting process is to identify the cash flows that are incrementally associated with that project. So any overhead that exists is going to be there with or without the project, right? So you have to include only those incremental cash flows, things that are related just because the project might come into existence, right? And of course, sunk costs should be ignored in this decision-making process. Imagine you have a firm. Let's do an example. So you have a firm. It has $80 million in existing annual overhead. That's going to be top management salaries, the corporate headquarters expenses, and so on. And that's a fixed cost, right? It doesn't increase, it doesn't decrease. Let's say that it stays the same, and you could potentially undergo a, let's say, 20% expansion or contraction in the current sales. Let's say current sales are running 750 million. Okay. So yeah, the overhead is fixed. Okay. So the firm wants to, let's say, put a new manufacturing facility in place. They think it's going to expand sales by, let's say, 10 million. So this is you got a new project, and you estimate an expansion in sales. Okay, 10 million additional sales. Now, if we add the plant, let's suppose let's say it's going to require $1 million allocated annually in the existing capital overhead. If the overhead is included as a cash flow outlay to the proposed project, the net present value here actually turns out to be minus 8 million. Okay, so if you allocate $1 million annually out of overhead, you wind up with a net present value of minus 8 million. If you don't include the overhead, the project cash flows have a net present value of 4 million. Okay. Should the company include the overhead in deciding, right? The answer is no. The overhead is incurred whether the project is there or not. It's not part of an incremental decision. It's what we'll call a cash flow that it has the characteristic as a phantom cash flow. What we mean here, the company-wide overhead is there regardless, right? The overhead aspect of cash flows shouldn't be part of the acceptance or rejection decision. Another example. Okay, another example. You should. Let's make an orange one. You should exclude historical events. Whoopsie! What did I just do? Right. I know I did. Get rid of that stuff. Right. You gotta. Pardon my quick and thoughtless pen choices. So you have to exclude history. Okay, that's leading us into the use of sunk costs. Suppose your firm has spent $500,000, and that's in time period T-1. Some project, like marketing research, let's say, is being done, and we're checking to see if we should introduce a new product. The key is, right now, the $500,000 in the market research is actually water that has flowed under the bridge and can never come back. You can't recover that money. You can't get it back if the project is rejected. See, so it's considered sunk. So the market research expenditure should not be included in our net present value analysis, right? And really, anything you could not recover should not be included. And this is analysis, we'll call it, do not include a net NPV, right, analysis, we'll call it, during time period T equals 0. Because the past is the past, and we don't have a time travel device. We don't have a TARDIS, right? Let's say you have a 10% discount rate, okay, and you have cash flow time period 0. Say it's minus 10,000. Okay, cash flow in time period 1, let's say, is 5,000, and let's say cash flow in time period 2 is 10,000. Okay. Draw that cash flow timeline. Okay, Okay, just do that on your own for some practice. And you can, for practice, double check the net present value. Okay, you just get your spreadsheet out and check. It's got a net present value of 2810. Okay, so you accept the project. It's adding to shareholder wealth, right? Let's say a year has passed and the project isn't working out very well. Let's say that no cash flow materializes at the end of the first year of the project. So we have to relabel time period T0. So let's go like this. A year goes by. And now we make an adjustment to reality. We go time period, right, in time period T1, cash flow has to be set to 0. All right. So you don't get any cash flow. And let's say you have to make an additional investment of $5,000. So you have more outflow during time period 1. And if you do that, let's suppose that right now you expect to get, let's say, $7,000, a year later. So we'll say it's to generate $7,000 a year. Now, if you do nothing right now, let's say you'll get nothing in 1 year. Okay. So, should you spend the $5,000 right now? Now, to answer that question, you go back to the timeline and you look at when you originally made the project decision. That was a year ago. Now assume what you know today, and change the project timeline. Right. So let's convert it to a red timeline. So the updating is over here. And you kind of re-establish your cash flow numbers. Right? The cash flow was 10,000 originally, right? And now you have cash flow in time period 1 is 5,000. Both are negatives, right? And then you realize, okay, then our estimate is that next year we'll get 7. And now when you draw this timeline, and let's say you do your 10% rate of return that's required, you notice here in this setup, you got a net present value equal to, right, minus 8760. And of course, you say, well, that's a losing prospect. Now the key is you don't have a crystal ball in the original scenario. So what do you do today? Right? The idea would be, would you throw good money at a bad project? Now, what's key here is the past is gone, right? So we're going to want to use incremental analysis, right? You got to ignore the $10,000 that you originally spent on the project. That's a sunk cost. It's unrecoverable. You have to focus on the cash flows that are truly incremental for your new decision, for your new time period T equals 0, which in our case is, right, time period 1. So you got to modify this, ignoring the sunk costs. And so what that looks like, let's do gray. What that looks like is, let's do, right, a new setup is that, hey, now I'm in, right, cash flow of 0. It's minus 5,000. And I'm at cash flow 1. And that's 7,000. So my net present value with a 10% rate of return winds up being $1,364. And I mean, you wish you would never have, expended the money in the past and generated nothing. But moving forward, you can make an incremental expenditure today and see shareholder wealth increase. Okay. Now, behavioral researchers know it's psychologically very difficult to continue a project that is losing. It's losing over time in the past. So the idea would be maybe we can recoup some of the shareholder losses in wealth if you can continue with the project. So you have to re-examine the net present value of the incremental cash flows at your new time point for your decision-making process. Okay. All right, so one more rule for today. Rule 4, well, today, I'm sorry, in this first part of my capital budgeting set of rules. Do not forget, right, opportunity costs. Do not forget opportunity costs. If a project requires the use of existing assets, and there are alternative uses, say you could sell some of the assets, or maybe you could invest in other kinds of projects, right? The opportunity cost is the value of the next best use, right? The next best use of your assets. So a prime example would be maybe you have some land, you own it. The land could be leased, it could be sold, it could be developed, right? It's not a free good for the project just to be, worked on. So a usual opportunity cost might be what we'll call a replacement cost, a market value of an existing asset. And what we have to do is charge that to the proposed project when you commit to the project. If the assets have no alternative use or market value, then the opportunity cost really is zero, right? And so you wouldn't charge anything to your project. You might have surplus square footage in a plant, and there's no alternative use for it. So, you think, oh, can I lease it out? Nope, maybe you cannot lease out that square footage, right? Actually, I'm going to keep going and let you guys just pause if you need to, because some of these rules are getting a little simpler to work on. Rule 5, right? Never neglect taxes. All right, all cash flows have to be net of taxes for the appropriate analysis, right? Corporations pay taxes on an estimated basis, right? Right, so they, through some accounting analysis, pay their estimated taxes. They do this quarterly. So on average, a firm is about 1.5 months away from a reconciliation with the IRS. A good example is when you have taxes of gains or losses on disposal. So you have an asset, and you think, okay, let's dispose of the asset. Yeah, maybe sell it. Maybe it's got some salvage cost or salvage value, right? And this is called Section 1231 gains in the IRS code. So go back to your MBA tax course, or if you're going to be studying that, and I recommend it as a good option in your electives mix, you'll come across the 1231 section. So let's say you have an asset and it costs $100,000 when you bought it, right? And you depreciate it, let's say, in a straight line across 10 years. So you got 10 years of depreciation. And not say 5 years have passed. Since you purchased your asset, okay. So now you have a net book value, right? Half is remaining, right? So you have net book value equal to $50,000. So let's say we want to sell the asset, and there's a tax rate that we face. Let's say we have a 35% statutory tax. So imagine some scenarios. Let's see what happens here. Scenario 1. Let's say it sells for $50,000. Okay. The sales price is equal to the net book value. So there's no gain, there's no loss. So there's no taxes involved, and what the sale is said to be free and clear. Imagine scenario number 2, though. Let's say it sells for $60,000. So the selling price is $10,000 over the net book value. So the firm owns some taxes on that gain at the disposal. Take 35% of the $10,000, and you have a $3,500 tax obligation. So net of taxes, the firm gets $60,000 minus $3,500, or $56,500, right, on that sale. Yeah, $56,500. Scenario 3. Let's say it sells for $20,000. Now the disposal price, right, of $30,000, or of difference is $30,000, right? So you've got a loss on the disposal. The loss is tax deductible. So now you have a non-cash charge, just like the depreciation expense. So this is going to lower your taxable income, right, by the tax savings, right? So you have a $30,000 loss, You have a 35% tax rate. See, so you have a $10,500 reduction in your tax obligations. Let's just call that the tax effect, right? So the net cash flow for this particular scenario would be, okay, my selling price, $20,000, plus my tax savings, right? $10,500. So $30,500 is the actual net cash flow from that situation. So you got to pay attention to taxes, right? Let's do rule number 6. Do not include the financing costs, right? Just a comment really on this one. This is a very common mistake. The capital budgeting analysis needs to ignore the financing of the transactions, right? We're going to raise money, right, for our project. And we want to also ignore any interest expenses on debt, any dividends you're going to pay on equity. You might have sinking fund payments. Ignore that, right? Any financially related cash flows, right? Now, a little bit later in the course, you'll come to fully appreciate why we want to ignore the financing costs. For now, just realize that the financing costs are included in the discount rate. They're already embedded in the value R, okay? And including them in the cash flows would be double counting them. So once again, right, the financing costs have to be properly determined, and they're going to be properly determined in the discount rate. That's right. So that leads us to, right, for now, just say don't double count. Seven, you got to treat inflation. You got to treat inflation consistently. Now, what do I mean by that? Okay. Really, you can think there's two ways to kind of look at the project's cash flows and the required discount rate. The one way might be to use nominal cash flows. And then we'll say, hey, use the nominal discount rate. Nominal cash flows mean the amounts of money occurring at when they actually occur. And such flows include any effects from inflation. Right? Suppose labor expenses are growing at about 5% a year. See, your pro forma statements that are constructed are estimating future cash flows, and that's going to be included. You're including the increase, right, in the labor costs. And then those nominal cash flows are discounted at the nominal interest rate. So what are nominal interest rates, right? Well, those are the nominal interest rates in the marketplace. Okay. The second thing might be to say, well, let's use real cash flows. If you do that, you're pulling out the effect of inflation. And if you do that, then you want to use real discount rates. Okay. A real cash flow is stating the cash flows in terms of purchasing power. You're backing out any impact of inflation. Okay. Then you'll want to use a discounting with the real interest rate. And the real interest rates, right, are the rates that are occurring over and above an inflation. Right? So real interest rates are actually not really directly observable. You have to take the nominal rates and you have to pull off the inflation rate to get you back to the real rates of inflation. Right? Now, to get a handle on real interest rates, this is really kind of a tricky part of this thing, right? The real interest rate comes from the work of Irving Fisher. And this is known as the Fisher separation or the Fisher effect. I think it's written out as the Fisher separation in most finance texts these days. Okay. What he did was he developed an equation that relates the nominal interest rates, the expected inflation rate, and the real interest rates. Okay. It works like this. So 1 plus the nominal rate is equal to, right, 1 plus the real rate, okay, times 1 plus the expected inflation rate. Okay, so let's do an example. And let's say that you observe the nominal rate on a 10-year corporate security. Let's say it's running at 9% per year. Okay. And let's assume now the expected inflation rate is 5% per year. So let's say the expected inflation that's going to work out through that same time period is 5%. Okay. Now let's use this equation and calculate the real rate of it. Right, so you got to go 1.09. See, that's the 1 plus the nominal rate element, right? And we have to set that up equal to 1 plus the real rate. Now I don't know that yet, right? So we got 1 plus the real rate. And that's times the 1 plus the expected inflation rate, right? So 1.05. So let's see that piece there is given here, right? Expected inflation rate. Double checking a little item in my notes that looks odd. I think I miswrote, so I just want to calculate something real quick. Make sure that it's correct. So hold on. Okay, I think we're good. Yeah, it's correct. Okay, so you just isolate, right? So you isolate 1 plus the real rate, so it's 1.09. Divide both sides by 1.05, right? And this generates a value, 1.03810. So you're seeing a real rate, right? Under the Fisher separation. We now obtained it. There you go. And that right, can be how you would identify a variable to plug into doing, real analysis of a project, right? And I want to do number 8 and on. Well, here's the lesson, and I'm going to just, on this one, right, watch out, right? Keep things, when I say consistent, it means this. Do not discount right, with real rates, the real rate, right, when you use nominal cash flows, and vice versa. Right? Don't discount with the nominal rate when you're using real flows. What will happen is you'll get really messy numbers that are basically inaccurate. So you don't want to do it that way, right? Now the last 3 items. I'm going to take a break. This might take me another 10 to 15 minutes. And I think this particular video is probably long enough. So what we're going to stop recording and get this one up into Blackboard for you guys, okay? All right, God bless.